Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared screen, the disclaimer. Be aware neither Market Chameleon, Dimitri, or myself are registered broker-dealers or investment advisors. If you need investment help, please reach out to a registered broker-dealer or investment advisor. This show is for informational purposes only concerning Market Chameleon tools and features. With that, do you want to get started, D?
Yep. Good morning, everyone. I'm going to share my screen here. Quick note to anyone joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's keeping an eye on it. He'll let me know and read those back to me. In the meantime, we're going to give you a couple minutes to put those questions in. We're going to take a look at our pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. So this pre-market report here, up top, we have this calendar view, which does let you go back in time if you wish, and it gives us some summary stats of what happened in the pre-market hours on those dates. And we do that for the last week. So you guys can eyeball and first of all, make a comparison what's happening today with what typically has been happening. Also, you may spot some trends or something unusual. You could go back to that date and see what happened on a particular historical date. Today, we are over here, April 2nd. As we could see here, we have 360 stocks that are trading higher in a pre-market, 573 stocks trading lower. If we look at the volume, there is 175 million shares trading on up volume, 80 million shares trading on down volume. And if we convert that volume to dollar value, we have $611 million worth of stock trading higher, $3.4 billion worth of stock trading lower. So that really points to a bearish bias in the pre-market trading. Let's look at it from a couple more perspectives, then we'll move on to our questions. And I'm going to scroll down here. And now we have this more granular view. We see now stock symbols. These are individual stocks trading in pre-market. We see their price changes, volume, alerts, and we have three lists here. Our most active stocks, our biggest percentage gainers in pre-market, and biggest percentage decliner. Here, we have 71 stocks that made our percentage gainers list, 170 in our biggest percentage decliners list. And this also indicates that so far, traders in the pre-market are leaning towards the bearish side. Now, to make this particular list, we do set thresholds because stocks in the pre-market can trade with very low volume or very liquid. So if the stock in a pre-market does meet those thresholds, it could make it onto this list, and that does include low cap stocks, ETFs. It could be an inverse ETF, closed-end fund. So to narrow this down to a smaller group of stocks, we can continue to use the filters above. If you have a watch list, most of our reports allow you to filter by your watch list. So if you're tracking a group of stocks that's what you follow and you want to see what's going on in that group, you could use that watch list filter. We're going to use this filter here in ETF, and I'm going to click on it. You get a drop-down menu to select from. We are going to choose the top one, SPY, and that's the S&P 500 ETF. So when we did that, you see that the list below got filtered by stocks that are holdings in the SPY ETF. So what we did was we narrowed down the group of stocks that we want to see this report by S&P 500 stocks, right? So now we only have S&P 500 stocks in here, and we could see that one stock made it onto our largest gainers list, met those thresholds, 39 on our decliners. And this also points to a bearish bias in pre-market trading. We looked at it from a couple different perspectives, and they all point to a bearish lean so far in the trading in the pre-market. So, well, we gave it a couple minutes. If you have questions, I'll take them now.
Yeah, there was a small discussion on does the platform auto refresh? Obviously, the data is 15-minute delayed, but does it auto refresh, or do you have to hit the refresh screen to get the new data inputted?
So you would have to refresh the screen. Keep in mind that this is a platform to conduct research. It's not to watch flickering stock quotes or try to make impulsive fast speed trading. You're using this platform to do a deeper analysis, to prepare, create your trading plan, really. So it's not there to sit there and watch a flickering stock. That's not what we created. You could have your execution system doing that, and you could have that on the side of your research platform, right? But usually,
But even if you have your TD Ameritrade or something to execute a trade, you also may have to auto refresh. I don't know if the prices are automatically refreshing, are they?
Yeah, I don't know, but certainly on execution platforms, you'll find your prices moving around, right? So they'll be up and down, but again, that's the purpose of this, is to conduct a much deeper analysis and research into the data. So that's what this is, and it works on the side of your execution system. You really shouldn't have an execution system and doing your research on one platform. That is really a very bad business practice, right? Because what is your execution? If you're doing that, you're just going to try to impulsively trade based on the excitement of changing prices, right? Like you're seeing things changing, and you think, oh, there's action going on, I got to act. But that's not research, right? That's impulsive. So as a business standard, since we've been trading on the floor and creating different trading algorithms and pricing models and risk management, you're not going to do that on your execution system that's sending you real-time fast speed information. It's just a standard to separate those. You got your research platform, you got your execution platform, you might even have a separate risk management platform, but you can't really have it all in one. So keep in mind, this itself was designed to be sitting on the side of your execution system. Even if you have a portfolio, you should have a risk management tools that is watching your portfolio, where you could also manage that.
All right, great. No other questions.
Right. Okay. So let's do the following. Go to SPY. It's usually, my default when there are no questions, to get some insights into some of the reports. And I had let me see. We had a question on skew, and it was a two-part question here. So one is, looking at the implied volatility, I'm gonna come out here because this was already an expiring. But let's say I'm looking at a particular option like in SPY. Let's do April 10th. And when we look at the skew, right, within the month. So this is looking at the April 10th skew. And what is the skew? It's, looking at how the implied volatility differs by strike. So we don't have so this isn't a vertical. This is looking at within the same month, same expiration month. And when we look at this, if we plot it, you could see here that the current stock is right there, and we have plotting it by strike. You could see that as the stock strikes increase, go up from that, the money, the skew slopes down, right? As the strikes go below that, the money, lower strikes, the skew goes up, which is typical in SPY. And the logic behind it is that as the stocks go up, there's more certainty. It goes up in a more orderly way, and you have people, buy writing and selling premium against their long positions. So it's expected to slow down its speed as it's moving higher, and the volatility, right? So it doesn't move as much back and forth. And as it goes down, it could be a shock. People pull bids, forced to sell. It could accelerate. So that's what it typically looks like. And in this situation, what we're looking at is, now that we have the skew, how does that skew change from one day to the next, right? So to see that, so it's not the same thing as implied vol, right? Like if we could measure implied vol over here, let's just go, here, implied vol, these are at the monies. So we could see, that the money implied vol went down from yesterday, up here went up. But what if we wanted to see how the entire line shifted, right? The entire skew from one day to the next, because we have all these strikes. The question is, well, did it, shift proportionally, right? From one day to the next, up and down, or it could shift in different ways. It could flatten, it could steepen, it could, the skew could increase on the upside, decrease on the downside. So how would we know that, right? How would we, because just looking at these prices, we don't know, and we can change this and say, well, what did the IV change by? So we could kind of see here from, the previous day how much it changed by. But really the best way to see it is visualize it by plotting it. So that's what this skews. So if we just wanted to take a look and say, well, how did that entire line shift? And we're going to be comparing it strike to strike, right? So we'll go April 10th. And we could see here that the blue line, that's the most recent day. The red line is the previous day, March 28th. Okay, and we could actually go back in time. So we could go back, March 25th, or okay, maybe this didn't exist. Okay, so let's go back. Let's go out like April 19th. See if we could go back there. Okay, so here we could even go back further in time just to see what the skew looked like back then. So let's compare this from one day to the next, and we could see here that the implied volatility, as you can see in the blue line, pretty much shifted lower across the board, right? So, you know, there are spots there, maybe it looks like not as much. What it looks like is maybe, you know, to the downside is more consistent than to the upside. But it pretty much just shifted down from the previous day. So yesterday, you know, you could see that the market was down, but very little, and it just shifted down a little bit. We could compare that, let's say, to March 25th. So from March 25th, we see a different story. So if we look at from March 25th, then the skew looks like it steepened, right, towards the downside. So what are we seeing here is that the puts, or I'm sorry, not the puts, the lower strikes, you know, we could say the put downside, lower strikes. Well, that seems to have shifted up in the last 3 days, right? If we compare March 25th to yesterday. So the demand there, or whatever they're definitely bid up there. And the downside, I'm sorry, and the upside shifted down, right? So the demand, it looks like the demand for the puts relative to the calls increased, right? So that's a noticeable difference there, right? You guys see that? So right here is the current price, right? So that's where the current price is, and we're comparing strike to strike. So there was a noticeable shift, you know, that was tilted, skewed towards the downside. You guys see that? And we could go back and say, okay, was that, let's see if that was, you know, March 22nd, definitely, right? So we could just see how that changes over time, right? So that's how the most recent is. And this is from yesterday to today. So this lets us go back a little bit further in time and just kind of visualize how that vertical skew has changed, and, you know, what maybe the market has been indicating, or the way it's been positioning itself on a relative basis, right? So what is it doing on a relative basis? As we go back, it's kind of positioning towards a more, let's see, right, that looking at it, the inference is that the upside here, if we're going to go up, it's going to slow down, right? So it's saying, what it's indicating is that we don't see that the risk to the downside is starting to increase relative to the upside. Okay, that it sees not as much room to go up as it is to go down. All right, that's how this particular expiration shifted. All right. So,
Hey, D?
yeah.
Rob is asking, how does skew relate to the volatility crush, or does it?
Well, so a volatility crush would really mean that the implied volatility came down across the board, right? So a skew is a little bit different because we're looking at this right now, and we could see that there was definitely a volatility decline towards those higher strike options, right? So right here, this is the red line, blue line. You could see the difference there. So what does the blue line tell us as we go up in strikes? So these are the strikes up here, you know, 530, 540, that, you know, as you know, compared to the previous days, there is a volatility decline, an implied volatility decline. Those options on a relative basis look cheaper, right? So on a relative basis, if we use the Black-Scholes model, they look cheaper than they were March 26th on a implied volatility basis. But implied volatility didn't get crushed across the board, because what do we see to the other side? Now we're going to the strikes below the at the money, and those show a different picture. The implied volatility actually increased in those options, right? And it continues to slope higher and higher. So the skew itself is not the same thing as an implied volatility crush, where the implied volatility crush, what does it imply? That implied volatility just went down across the board. The skew is saying that on a relative basis, if we are looking at, all the strikes and how the implied volatilities are moving, they're shifting around, right? So the skew is shifting around, where now the demand for puts, right, demand for downside, exceeded the demand for calls or the demand for upside, right? So that's what it's, bullish. It's more favorable towards bullish puts than bearish puts than bullish calls. So that's how this skew shifted. You guys see that? So that's what it's doing. It's measuring the implied volatility strike by strike. Okay. So that's looking at it from a vertical point of view. That's within the same month, right? So within the same month, we're just comparing the change from day to day, right? So it's like, when you compare a stock price from day to day, it's easy, right? Because you could say it was this price, then this price. But when you're comparing an entire smile, well, you got lots of different strikes there to compare. So the easiest way to do it is to plot it and visually see how they moved, right? So some of them went up, some of them went down. So that's what we're looking at, that the smile changed. All right, so that's one way to analyze and see how the implied volatility has shifted. But what if we wanted to compare the expirations? So the expirations, you can see here, you have different expirations here, and the implied volatilities are different. So what if we just wanted to compare one expiration versus the other? Well, here we could go over here, compare expirations. And this plots us just as an example, the first three, but this one expired. We don't really need it. These are two very close, but let's say we wanted to come out a little bit further and compare April 19th and May 17th. Let's compare those two. So now there are two ways to look at it. One is we could just compare how the implied volatilities strike by strike look, right? So if you're just doing a straight calendar spread, right, you're thinking about a calendar spread in April 19th versus May 19th, and you just want to compare the strike by strike. Well, now you could just visualize it, and you could see here that as we go higher, right, as we kind of go higher, that April implied volatility is below the May implied volatility, right? Strike by strike. So April is cheaper on a relative basis than May. But if we go all the way out here, strike by strike, that kind of shifts as we go lower and lower in strikes, right? So this is how the implied volatility term structure. So when we think term structure, we're talking about different calendar days. We're comparing implied volatility to different calendar days, but there's lots of strikes there to compare, right? You have lots of strikes to compare along the curve. So here's a third one, so how do I do that? Well, the easiest way is to plot them, just plot them versus each other. So this is looking strike versus strike. But what if we wanted to normalize it to a delta? And what this will do is say, okay, I understand strike versus strike, but let me compare a 50 delta versus 50 delta, 25 delta versus 25 delta. So we could do that by switching this graph over here by delta. And now we see that it's a little bit more symmetrical, more in line with each other, right? So this gives us a little bit of a different view. And let's go, because now we just normalized it. Let's see the next one. Let's see June. So you could see here, they're a little bit more in line. And what it looks like now is that they take on a similar shape. And as we go out further in time, right, as we go out from April, the yellow line, to May, this blue line, to June, the purple line, the implied volatilities are shifting higher. Okay. So that's really quickly, we looked at two different ways to analyze the implied volatility skew, right? One is within the same month and comparing how the IV shifted from historical dates, and then how to compare different expirations versus each other. All right, well, we're right up at 9:30, so I'm going to stop right there.
All right, Dima, great job. Rob, is this explained in the blog or the options features guide? He's asking.
I don't think, I mean, I may have, may have written some blogs as an example, not as just showing like, oh, look at the NVIDIA skew, or, so I don't know, like as an instruction, if I have anything, blog like that. I have to, but if I could recall, I'll share it tomorrow. Off the top of my head, I don't remember if there's like a specific blog explaining the steps we just took.
I'm actually looking at YouTube to see if you have done 2 videos on skew, which I'll share with Rob. Maybe he'll find those helpful as well. I did put in the link. We're a week away from our next IBKR webinar.
Yep.
So I put a link on the stock contingent webinar you're going to do. So that's next Tuesday at 2. You have to register on the IBKR website. With that, D, thanks so much. Have a great day.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Bye.
Bye.